Alright, welcome back guys. In this video we are going to talk about taxes. Before we begin, let me be clear. I'm not an attorney, I'm not an accountant or a financial advisor. So the information I'm sharing is strictly for educational purpose and should not be considered a professional advice. Since every situation is unique, I strongly recommend you consulting a qualified professional before making any decision based on this content. With that important disclaimer out of the way, let's begin creating a publishing business that not only generates an income, but it does it efficiently and securely. Making money with KDP is great, but keeping that money is even more important. Too many authors or publishers focus only on sales. Then they get shocked when taxes and legal risk eats up their profit. The truth? Without the right setup, you could lose thousands to unnecessary taxes or even put your personal saving at risk. That's why in this course I'll walk you through a real step-by-step strategies to protect what you earn. Not many complicated theory, just clear practical advice to help you keep more of your hard-earned money. So let's begin with the core principle. If you treat your Amazon KDP publishing business like a hobby, it's going to cost you like a hobby. But if you treat it like a proper business, you unlock the benefits that business enjoys. This isn't just about uploading your books to Amazon and hoping for sales. It's about adopting a proactive approach from day one and understanding the financial, legal, and tax implication of what are you building. Because here is the reality. The tax system works very well, but it's designed to take money from those who don't grasp the rules and rewards the one that does. So consider this. Employees trade time for wages and face heavy taxes on every dollar they earn. Business owners, however, operate under different rules. Rules that allow us to retain more of our earning. If you're running your KDP sideline without treating it as a genuine business, you are making two serious errors. First, you are missing out on ways to reduce your tax bills, expenses you could deduct from what you owe. Second, you're putting everything you own at risk because without the right setup, your personal and business affairs are tangled together. One issue like a legal challenge and your home, your car, your saving could be in jeopardy. Now I know some of you are thinking, but hold on, I'm not making much yet, so why bother? Let me stop you right there. The tax people don't really care if you're rolling into cash. They care if you're serious. In the US, you can lose money on your business for years and still use that to cut your tax bill. Even if your KDP business isn't huge yet, setting up right can save you cash by lowering what you owe from a regular job. If you got any income, it's almost always a no-brainer to act like a business. So what does it mean for a KDP publisher? It means keeping track of every penny you spend, your laptop, your internet, your Canvas subscription, even the coffee you drink while you're planning books. It means keeping your personal money and your business money separate. Rule number one, don't mix them up. And most importantly, it means picking the right setup to keep you safe and save taxes. Let's have a look at it. Okay, now that you are thinking like a business owner, let's figure out how to set up your Amazon KDP business so you pay less the government and stay safe if something goes wrong. This is where a lot of people make mistakes. They either do nothing and lose out big, or they make it too complicated and waste money on stuff that they don't need. I'm here to keep it clear, easy, and doable. Mostly for the people in the US, but I'll talk about other countries later. We're going to cover 4 things. Why doing nothing is a trap, number 1. How an LLC gets you started, number 2. When an S Corp saves you more, number 3. And number 4, when a C Corp might work. You started selling on Amazon KDP, but you haven't picked a setup. Guess what? You're automatically in a do-it-alone, self mode. That means that your business and you are the same things to the low. No form, no fees, no headaches. Sounds nice, right? Nope. This is the worst way to run your KDP business. And I'll explain why so you really get it. First, you've got no safety net. If someone sues you, maybe they say you copied something in one of your books. I mean, they're not just coming after your business, they're coming after you. Your house, your car, your saving, all up for grabs. Think, you made a book or a cover and someone says it's too close to theirs. Even if it's a silly claim, fighting could cost you, I don't know, $5,000 in lawyer bills, you know? Without a setup, that's your personal money gone. Out. Or let's say a customer blames you, your book for something crazy, like, you did a planner and there is a typo and you messing up their week, something like that, and he tried to sue you. It's not likely, but it happens, and you are wide open with no protection. Second, you're losing out on tax savings. When you're on your own, you pay an extra tax, about 15% on every dollar you make, and you can't use the tricks that proper setup gives you. Let's use some numbers. Let's say you made $10,000 last year from KDP. On your own, you're paying $1,500 in that extra tax plus regular taxes. If you're not writing down your stuff, you spend like $50 a month for internet, $200 for softwares and tools. You are missing out on cutting that $10,000 down by $500 or something, which could save you another $150 in taxes. Someone with a better setup keep that cash. Here's another thing. The tax people don't see you as a real business without a setup. So that makes it hard to use losses, like if you spend more than you make, to lower your tax from a regular job. I don't really care if you only made $500 this year. Doing it alone is like riding a motorcycle with no crash helmet. Although I've done it in the 80s and 90s, but you might be okay for a bit, but when trouble hits, it hits hard. And it's a beginner mistake. And I'm sure you're smarter than that. Let's have a look at something better. The LLC, your first smart move. So this is where sharp KDP entrepreneurs like you and me starts. An LLC or limited light company for a few $100, usually $300 to $600, depend where you live. An LLC gives you two huge wins. First, safety. If your business gets sued, they can only take what is in your business, not your personal stuff. Your KDP money might not seem like a big target right now, but if you grow eventually, this safety is gold. Second, tax choices. An LLC lets you pick how you want to handle taxes. You can stick with the solo way at first, or team up with someone, or switch to a bigger setup later as you make more. Now let's talk about that safety part. Let's say someone sues you for $20,000 over a book idea that they think you took. With an LLC, they can only grab what is in your business account. Maybe $2,000, your personal saving, your retirement money, your house, your car, safe. Without an LLC, that $20,000 could clean up your personal cash or whatever you got saved. Even if lawsuit feels like it's not a common thing in publishing, I know. But knowing that you cover is worth it. Plus, an LLC looks legit. To Amazon people you work with, to anyone checking on you, it looks serious. Now, the tax bonus. You can start an LLC today and use stuff you spent money on months ago. If you've been on your own and kept all the receipts, like for the internet or laptop or your ads, you can deduct those with your new LLC. As long as this is real business stuff. The tax people let you count those old costs to prove you are serious. Say you spent $1,000 on a laptop in January and $200 on ads in March, and $50 a month for the internet. That's $1,500. Start your LLC in July and you can use that $1,500 to lower what you owe this year. Maybe saving $450 if you're in middle tax group. That's money back before you even start making money. How'd you do it? Search online for LLC in your state. Most places let you sign up quick. I know that in Texas it's $300. In California, I think it's $70 plus $800 yearly fee. In Wyoming, it's just $100. There are companies that can do that for you. Fill out the papers, make a simple rulebook for your business, and get you a business ID number. That for about $300 to $600. That ID number lets you open a business bank account. Do it right now. So you got to pay a small fee every year. $50 in Wyoming, up to $500 in California. So look up what's your cost. Where should you set it up? Well, your home state is easy, but Wyoming keeps your name private. Delaware is another good name for business stuff, and Nevada skips some of the taxes. You will see that name reoccurring very often. For KDP, your state usually is fine unless you really want to hide your name. When should you start? As soon as possible. Don't wait until you're making millions. The tax people like it when you act seriously from the beginning. It lets you use startup costs to cut taxes from a regular job as well. Imagine you're a teacher making $60,000, spending $5,000 on KDP for laptops, ads, apps, subscription. With an LLC, you lower your taxable money to $55,000, saving $1,500 in taxes. That is cash back before you sell. But wait too long and you miss that out. Do it now. So switching to an S Corp. Okay, let's say your KDP business is doing great. You're making $50,000 to $100,000 or more. If you're still on your own or just using a basic LLC, you're losing money on taxes, especially that extra 15% tax we talk about. This is where an S Corp comes in, and it makes sense. It's a big win for US people hitting these numbers. An S Corp is not a completely new thing, it's just a tax switch from your LLC. You fill out a form, number 2553, with the tax people and your LLC starts saving you money. Here is why it's good. On your own or with a basic LLC, you pay that 15% extra tax on every dollar you make. So if you earn $100,000, $15,300 goes poof. With an S Corp, you pay yourself a fair salary, let's say $60,000. You only pay the 15% on that $60,000. So that's $9,180. And the other $40,000 comes to you without that extra tax. Boom. You just kept $6,120. Let's use a real KDP story. Your books makes $120,000 this year. After spending $40,000 on ads, you got left $80,000. On your own, you pay $12,240 in that extra tax. Switch to an S Corp and you pay yourself $50,000 as a salary and it's only $7,650. You saving $4,600 roughly. When you're making $50,000 to $100,000, this can save you 7 or 8% of your cash. Now you might ask, what's a fair salary? About half of your profit, like $50,000, $60,000 on if it's $100,000. Look online what online seller makes. $40,000 to $60,000 works for KDP. You need a payroll service. It's about $50 a month and an extra tax form every year, but it's worth it. Don't mess it up by paying yourself $1 on, like huge amount of money. The tax people will catch that. Keep your business and personal money apart. Use separate account. That's it. You're sorted. So you're making $4,000 a month consistently. It's time to switch. Do it in the fall if you think you'll hit $50,000 next year. So now we got C Corps. When they fit and when they don't. You must have heard of C Corps. Big names like Amazon use them. For most KDP people, they're too much. Why? You get taxed twice. The business pays tax on what it makes, 21%. Then you pay again when you take the money out. So it could be 40% total instead of 20 or 30% with an NLC or an S Corp. When is it okay though? If you're getting big investors, which is not likely for KDP, keeping it over $200,000 in the business, or need a US setup from another country, otherwise just stick with LLC or S Corp. Now that you're set up good, let's talk about retaining more cash with tax savings, especially for KDP entrepreneurs working from home. In the US, there is a lot of stuff you can deduct, like your phone bill if you use it for business, your internet, part of your rent for a home office, ads costs, shipping for sample books, even this course if it helps your business. But let me give you an example. You pay $1,200 a year for the internet and you use it half for KDP. Making covers, uploading books, running ads. That's $600 you can deduct. Your home office, a desk in your room, 100 square feet out of 1,000 square foot lets you take 10% of your $12,000 rent onto $1,200. Add $500 for subscription like Canva, Helium 10, Bookbeam, $100 for a business lunch, and $300 for a printer, let's say. That almost $2,700 could save you $800 or more in taxes. You got to track it though. Track it all. Use an app, a notebook, whatever it works for you. You skip this and you basically give away money. Remember what we said, the tax system reward people trying to build business, even if you're not making much yet. In the US, you can lose money 2 out of 5 years and still use that to cut taxes from a job. So you spend $10,000 starting KDP, but you only make $2,000. Let's hope not. But that $8,000 loss could save you big. That's better than some places where losses don't help at all or don't help as much. Keeping your stuff safe helps as well. LLC splits your personal and business things. So if someone sues you, they can't touch your personal cash. One book complaint could cost you $5,000 to fight without this. Why risk it when an LLC is cheap? Plus, get a business credit card, pay on time, and you can borrow for ads or help without using your own money. That's how you grow smart. Now, if you're not in the US, maybe you are in UK, Canada, or Australia, the idea are the same, even if the name changes. Every place gives perks to people who set up their business right, but the details are different. Let's have a look at how you can use this wherever you are. So in the UK, you start solo, no fees, easy. You can deduct stuff you spend, but switching to a company, it makes sense when you're making decent money, let's say £30,000 or something, because rules get stricter. A company keeps your personal stuff safe and save taxes, like paying 19% instead of paying up to 45%. Say you make £50,000 from your KDP. Solo, you pay 11,000 in taxes. With a company, it's 9,500 and you take extra cash, saving over £1,000. Remember, talk to a UK solicitor or an accountant to get the timing right. In Canada, you go solo, then switch to a company. At $50,000, a company saves you paying 12% instead of up to 50% in some spots. In Australia, it's solo to a company, $75,000 or so makes it worth it with a 25% rate. Every place works like the US, so split your stuff, keep it safe, save on taxes. Check what is available in your country. Now, if you're outside the US, but you need something from the US, like a number for KDP payments or a bank account, a Wyoming LLC is a great pick. It's cheap, it's $100 to start, no extra state taxes, and keeps your name private. You can set it up to avoid extra US taxes if your country has a deal with the US. Say a UK KDP seller uses a Wyoming LLC. You make $20,000, pay $4,200 in US tax, but your UK deals means you don't pay twice. Your main setup, like a UK company, handles your home taxes. Again, speak to a solicitor or a financial advisor. Ideally, someone who knows both places. Selling across the border can get tricky, but deals between countries help you avoid paying twice. The US has these with loads of places. A Canadian KDP seller with a US LLC can use US taxes paid to lower Canadian taxes. Same for Australia or Germany. It's about paying once, basically. Watch out, miss a form and you could owe, $1,000 extra. So my suggestion is spend some money on a tax professional who knows this stuff. It will save you way more than what you're going to spend. So here's the deal. Taxes are a game. Kind of a silly one, but you can win. It's not about how much you make, it's about how much you keep. So get an LLC going today if you don't have one. Making more than 50K a year already? Looking to start an S Corp. Write down every penny you spend, keep your money separate, and talk to a pro to make it fit to you. You work hard for your KDP wins, so it might as well worth keep the cash you deserve. Most importantly, start thinking about this sooner rather than later. Thanks for watching this video. I'll see you in the next one.